Hello, hello, hello. I hope everyone can hear me now. Welcome to the advanced aspects of trading course. We'll just give a few minutes for people to join if they haven't yet joined before I actually get into the presentation itself. Obviously, this is the second week of our presentation of the advanced aspects of trading course. Thanks for joining. We had a really good turnout last week. I was amazed by how many people came along, and I thought it went pretty well. And we're going to be picking up this week from where we left off last time. So we looked last week at a company's financial statements, and we looked at the income statement and the statement of cash flows on the balance sheet. We also looked at financial ratios, in particular valuation ratios, and how we can use those as a kind of yardstick for comparing peer companies, one to another, similar companies, to try and work out whether we think a company is cheap or expensive. And that's where we're going to be picking up this week by looking at some other valuation ratios. Now, I would say, before we get into the talk, if you have any questions as we're going along, just make a note of those questions, and then there will be a section at the end where you can put those questions into the Q&A, and that's where I will address any questions you have as we're going along. Just before we do start, why don't you fire into the chat any just let me know where you're from, which city or which country you come from, just so we can have an idea of what kind of range of people we have joining us today. And before we do get into the talk, I'd just like to draw your attention to the disclaimer, just pointing out that everything in this talk is solely for the purposes of education. We're going to be talking about valuing companies, but none of it amounts to any kind of recommendation. It's just purely for the purposes of expanding your knowledge. So just take a moment here to read the disclaimer, which is important. Okay, so let's get into the talk. So, quote here from Confucius: the essence of knowledge is having it. The essence of knowledge is having it to apply it, not having it to confess your ignorance. Now, we could say this applies to trading and investing as a whole. We're trying to expand our knowledge base, and we're trying to use that knowledge as best we can. But at the same time, we're trying to be wary of any areas in which we might have gaps of our knowledge. And then we're trying to, as I say, expand your knowledge base, because, as I said last week, the more knowledge you have, the better positioned you're going to be to make informed trading decisions. So let's run through what the agenda is for today. We're going to be starting off with this concept of the intrinsic value of a company. We'll be talking about what does that mean, trying to explain what that concept is. Then we're going to be talking about three valuation methods. One of those is the one we looked at last week, which is the peer comparison, comparing one company to another using valuation ratios. And then we're going to be focusing for a large part of this presentation about valuing a company by looking at its cash flows, its free cash flows in particular, and then this thing called a discounted cash flow analysis. We're going to work through an example of that to show you how it works. It's pretty complicated. It's pretty in-depth. If you stick with that, you can stick with anything, because that's probably the hardest thing we're going to go through in the whole of this course. And then we'll finish up by looking at some red flags, just one or two things you might want to look out for when you're trying to do fundamental analysis to try and invest in companies. And then we'll finish up, as I said before, with some questions just for the last 10 or 12 minutes or so. So, okay, let's talk about this concept of the intrinsic value of a company. We said last week that really the core of fundamental analysis is trying to answer whether we think a company is cheap, whether we think it's expensive, whether we think it's the right price. And what goes hand in hand with that is this idea of the intrinsic value of a company. We can almost think of this as being the true or fair value of the company. And that's in contrast to what we call the market price of a company. The market is how the market value or the market price is where the market as a whole, or the participants trading in the market, appraise the value of a company. Now, that may be the same as what we work out as the intrinsic value, but it might differ. When it does diverge, that's where we get into the idea of whether a company is cheap or expensive. So if the market value is less than what we value the intrinsic value of the company as, we might consider that as a chance for investing because the company looks cheap. But if the market value is higher than the intrinsic value, we might consider selling or shorting a company, because that would give us it would communicate to us that based on our estimation of the intrinsic value, that it is too expensive in the market. But we have to be wary, make note of this. Even if our appraisal of the intrinsic value is correct, even if we get all our estimations on the money, it might take a long, long while for the market value to actually come in line with those fundamentals. There's nothing that says the market has to pay attention to that. The market can do what it wants, of course, but we would believe that in the long term, the fundamentals will hold sway. Come back to our old friend Warren Buffett here again. Now, we've got a quote from him that gives his view of what the intrinsic value is. Now, an awful lot's been written about Warren Buffett because he's been so successful at investing. I think there's more than one ways to think about intrinsic value, but this is his view. He says that intrinsic value can be defined simply. It is the discounted value of the cash that can be taken out of a business during its remaining life. Now, there's obviously quite a lot of logic in that. If a company generates a certain amount of cash over the life of the business, and the current price seems to value it in a way that is lower than the cash that you think will come out of it over its life, then that implies that it's being undervalued, that it's too cheap. Now, it has this slight twist there, this theoretical thing about discounted value. We're going to come on to explain that later on. It's a kind of difficult thing to get your head around. We'll come back to that in a second. And we can see there's a graph here where we've got the value of the shares and then the intrinsic value of the company. If the market value falls below the intrinsic value, then it starts to look cheap. We've got marked on here this thing called a margin of safety. This is because, as we'll see when we get into trying to work out the intrinsic value using this method of discounting the cash flows of over the life of the company, there's quite a few estimates that have to go in, and we might make a mistake. So to give us a bit of wiggle room, we apply this margin of safety. How much you apply is down to the individual, but it means that even if you get some of your estimates wrong, it gives you a bit more, as the name suggests, a bit more of a margin of safety. So we said there were three valuation methods broadly, and the first one is the one that we talked about last week. If you recall, we talked about looking at valuation ratios, things like price to earnings, the P ratio, or price to book value, or price earnings growth, PEG ratio. And that's kind of these broad measures that allowed us to make an apples for apples comparison between companies. So similar companies, to try and say, okay, here's the company I'm interested in. How does it measure up against its peers? Does it look cheap according to these measures, the valuation ratios? So we've talked about that at some length last week. Two other methods, an asset-based approach, really just looking at what the value of the company is according to its balance sheet, that book value that we talked about last week, and trying to work out whether the company is undervalued from that. And then a full-blown discounted cash flow analysis, looking at the cash flows, the free cash flows of the company. So we'll, as I say, look at that in detail. You could use all three and use them as kind of general guide. But let's talk just quickly about the second of those three methods. This is the net asset valuation, trying to actually work out what the company is worth from the things that it is made up of. So in a nutshell, we're putting a price tag on everything that comprises the company. We're evaluating the company's assets. We'd look through its balance sheet, and we'd look through all its liabilities. We'd look at the assets and the liabilities, and we try and do our own valuation on what those are. Are they recorded correctly on the balance sheet? Now, the values of those things, they might actually diverge from what we think they're worth to what the way they're listed on the balance sheet. We spoke a bit last week about how accountants might value things. They might for example, put down a value for a property that doesn't necessarily represent the current market value. And so if we went through that and looked at all the assets, valued them up, looked through all the liabilities, valued those up, subtracted the liabilities from the assets, that gives us our value for the company, which we can then compare to the market value. As it says at the bottom here, this works best for asset-heavy companies. So, for example, property asset management companies where a large part of the company's value is tied up in what it actually owns. If you could then spot that some of the valuations on its balance sheet don't really match for some whatever reason market values, true market values, you might be able to spot some opportunities potentially. So now let's move on to looking at these using free cash flows as a way of measuring the value of a company. So we've got this quite simple example we're going to use just to get the concept across. Pricing a golden goose. So imagine that you've got a 3-year-old goose and it lays 2 golden eggs per year, big fat gold eggs, and that geese live on average 15 years. So we're going to try and work out, what is this goose worth to us if one egg is worth $1.5 million. So what is the goose worth? So what we might assume that our goose that's 3 years old, if geese live 15 years, we're going to make an assumption, our first estimate, that it's going to live 12 more years. We don't know that for sure. There's some uncertainty there, but it seems like a reasonable estimate based upon what we know. And therefore, if it's going to lay 2 eggs per year and we think it's going to live 12 more years, that means we're going to get 24 eggs out of our golden goose over its life. If each egg is worth $1.5 million, then we're going to get 24 eggs times $1.5 million each. It gives us $36 million over the course of its life. And let's make an assumption that gold keeps pace with inflation, so we don't need to worry about inflation. This is really, really simple. So we've got across, though, the concept where our goose is churning out valuable items. We tot up what we think they're going to be worth over the course of its life, and it gives us a kind of rough value for the goose as a whole. But maybe it's a bit more complicated than that. So let's look at some other considerations. We might have that, in fact, the goose's mother laid 2 eggs per year for the first 8 years of her life, but then she slowed down. So she had this more rapid rate of laying eggs when she was younger. As she got older, she only lays 1 egg per year. So she's 1 egg per year. So she slows down how much she's outputting in terms of dollar value to us. And we also have to pay some money to look after her, for feed her, house, and secure the goose. And we might pay insurance costs. So let's say that costs $20,000 a year. And as I said before, to simplify things, what we're going to do is make an assumption that gold is going to keep pace with inflation. So we don't need to worry about that. So let's make some more estimates. So we're saying, still assuming our goose is going to live till it's 15, so it's 12 more years of its life. But we're going to assume that for the first 8 years of its life, so 5 years on from when we got it, it's going to lay 2 per year. And then it's going to lay for the remaining 7, 1 per year. So that gives us 17 in total. And at $1.5 million per year, that's $25.5 million. And then our costs, 12 years at $20,000 a year, is $2.4 million. So if we actually break this down so we can see how it works, we have this table on the right. So we see the age of the, it says swan here, but it's a goose, of course. And then we have the eggs it's laid each year, the value of the eggs it's laid in the year, the cost, the net profit we make, and then totted up at the end gives us 23.1. So the overall value of the eggs, 25.5 million. We pay out a cost to look after our goose. So it takes off some costs for looking after or owning it. And then we make an estimated value of 23.1. So if we could buy the goose for less than that $23.1 million, we might think that it's cheap. If the price of the goose valued by its owner is more than that 23.1 million, then we might think, well, that's too expensive and we won't put our money into it. And once again, we've got to note, we made some estimations. We could be wrong about those. There is uncertainty. None of this is cast iron fact. It's using our judgment. But it's a logical judgment based upon what we know. Now, this is similar to appraising the value of a company through a discounted cash flow, a DCF. So that kind of analysis looks at a company and effectively does what we did when we were praising our goose. We look at the company purely by how much we get out of it in terms of cash flow, like Warren Buffett says, over the course of its lifetime. We don't look at what makes up the company. We don't look at what comprises it. We don't look at its assets and its liabilities. We just look at how much free cash flow we think it will get over the course of its life. Now, there is an added kink in the process, though. I glossed over it with the goose by talking about gold keeping pace with inflation, but that doesn't happen with a company. What we're talking about now is looking at how much money the company produces in its life, i.e. there's going to be money years and years into the future that the company's producing, but we're trying to value it now. So there's a slight complication there where we need to try and work out future values in today's values. So this brings us on to this key concept, the concept of the time value of money. Cash in hand today is worth more than the same amount at some point in the future. For example, a millionaire in 1960, we understand, was a very rich person. That's a lot richer than a millionaire today. £1 million today doesn't quite get you the same as it would have done 70 odd years ago, where you would have been set for life. Now, if someone offered you £1,000 right now, or promised to give you £1,005 in 1 year, which would you take? So in the chat, just take a moment to pop in your answer. Would you take the money now, or would you wait and get you a bit more money in a year's time? So the answer is, if you're being sensible about it, and given what we know about inflation, you would take the money right now. And the reason for that is on account of a number of effects which affect the time value of money, one of which is inflation. So the purchasing power of our £1,000 would be devalued over that year. Inflation's running, depends which country you live in, but it's 4, 5, 6%, depending on which measure you look at. So it would devalue your £1,000 by that amount. There's also a question of risk. In this case, counterparty risk. Do you trust the person who's offered you the money to give it to you in a year? Something might happen that compromises their ability to give that money to you. And that's especially pertinent when we're talking about cash flows from a company. We're going to be projecting that it's going to get what cash it's going to produce, but we are guessing or estimating to a degree that it's going to keep on producing money, and something might affect it adversely that stops its ability to produce that cash. And then finally, there's this notion of the risk-free rate of return. We could take our £1,000 if we were given to us right now. We could invest it in something that is so secure that it's effectively can be considered effectively a risk-free rate of return. For example, government bonds, you could put your money in that, receive a certain yield, maybe 3 or 4%, and then you get that much interest on that £1,000, and your £1,000 in a year is going to be worth more than that 1,005. So let's now look at DCF analysis, discounted cash flow analysis, in a kind of broad term. It is complicated. If you find at any point it's getting too complicated, you want to just take away some key takeaways from this. So we've got at the top of this diagram, the annual cash flows over the life of the company. So we start with cash flow in the year 1, cash flow in year 2, cash flow in year 3. For the first period of the company, we're going to use a midterm growth rate estimate. So there are basically 3 things that we're going to have to estimate. And one of those is this midterm growth rate estimate. So this is a little bit like with our golden goose, when it was laying its eggs at a faster rate when it was younger, and then it sort of eased off as it got older. This is what we tend to assume with companies, that they will grow faster when they're younger, and then they will settle back into a long-term growth rate that's a lower rate that tends to align with the broader growth rate we see from the stock market. So rather than trying to work out the cash flows individually each year ad infinitum. We just do it for a certain number of years, typically 5, 6, 7, maybe 10. For the purposes of our example, we're just going to look at 5 because that keeps things a bit easier. And then we've got this other cash flow amount, which we just call, it's effectively, we say there's this big lump of cash that we think the company will produce for the rest of its life. And this is what we call the residual or terminal value. And as I say, we have a second estimate that defines that, and that is the long-term growth rate estimate. And then finally, once we've got all those different cash flows, we've got the first, second, third, fourth year, fifth year, and then we've got the big chunk for the residual value, their future values, and we have to draw them back to present day values. Bit of a weird concept. Can be quite hard to get your head around that, but we're going to have to work out some rate that we're going to apply, which is called this discount rate. That's another estimate we're going to have to make, the rate that we're going to discount that back, the future value, to a present day value. And we add this all up, and that gives us what we consider our intrinsic value of the company, from which we're going to make a judgment call as to whether we think this company is cheap, the right price, or expensive. Very quick word on cash and earnings. This is really just reiterating stuff that we covered last week. So can you remember we talked about the company's P&L, its income statement, and we also talked about its statement of cash flows, and they're not necessarily the same thing. So what a company says it is earned, its earnings, its net income, its profit, doesn't necessarily equate to the cash brought into the company. And that's because of various things, but mainly accrual accounting records, accrual accounting, which records transactions when they occur, not when they're paid. So the vast majority of companies do not report on a cash basis. They report on what's called an accrual basis. As we say here, it's when the transactions occur. If you sell something, doesn't matter whether the customer's paid for it or not, it records as a sale, as revenue coming into your company, from which you're going to work out a profit. Cash flows separately reveal how much money actually came in from business operations during a reported period. If you're looking at a cash flow statement for a company, then if it's negative, that means the company spent money. Positive entry means that the company's got cash coming in. So when we look at the statement of cash flows for a company, we're trying to work out for this calculation the free cash flow, but it's not actually listed as a specified item on a company's statement of cash flows. You have to calculate it. It's not particularly difficult. So you look at cash from operations, which is one of the items that is listed in the statement of cash flows. We then look at its capital expenditures, CapEx, what it spends on investment in its machinery, on its factories, on expanding its storage facilities. And we take away the capital expenditures from its cash from operations, and that gives you its free cash flow. So I'm just going to try and share a screen with you now of, let's have a look here. Okay, so this is just in eToro's trading app, and I'm looking at Coca-Cola. And then now this is Guru Focus's website. Actually, I don't want to show you that quite yet. What I want to show you is this. So this is Coca-Cola's annual statement, and it's from that annual report, it's the statement of cash flows. So we can see that the net cash provided by operating activities is listed here. So that is the one of the numbers we would use, and then we would look in the investing activities, and we would look at purchase of property, plant, and equipment, and that effectively is our capital expenditure. We subtract that away from the net cash provided by operating activities to give us the free cash flow. So that's the first part we do of our DCF analysis, but there's quite a few other things we need to look at still. So bear with me because we're going to go through them all. So the information we require is the free cash flow, which we've just talked about. And we want the current one, the one from the most recent annual account. We also need the number of shares outstanding. That one's not particularly difficult either. That will be in its annual statement as well, its annual report. Then we've got a few other things. The expected midterm growth rate. So we talked about the company growing over that intermediate period, 5 to 10 years. So we're going to have to estimate something there. And then an expected perpetual rate. So that's for the working out the long-term growth of the company. And that will give us the residual value or terminal value. And then a discount rate, which is probably the most hard concept to get your head around. So it's this rate of return that we're going to use to discount the future cash flows back to present values. A way of thinking about this is it's a rate of return that investors would demand in order to get their cash. And the idea, it stems from modern portfolio theory, where it basically says that if an investor has the choice of investing in two things, they're going to, and they both yield the same amount, then the investor will always opt for the one, or in theory, opt for the one that is the less risky. And from that, it suggests that something that is more risky will always require a larger return in order to attract investment. And so if we think about what kind of investments are available, you get the concepts of risk-free rate of return, which we said we can use government bonds, and then corporate bonds are a bit more risky. So corporate bonds would pay a higher yield than government bonds. And then stocks are even riskier still than bonds. And so we need a higher rate to attract investors if we're investing in stocks. So that's going to factor into our thinking, working out this rate, which we will then work out when we're discounting our future cash values into present values. And in this list, the first two, the free cash flow and the number of shares outstanding, there's no argument over those. Those are factual, 100% based in fact. But the other three things on our list are a bit more tricky than the less solidly based in fact. We're going to have to make some estimates. And when you make estimates, they're subject to error. They're subject to uncertainty. So we just need to be aware of that. So then we need to talk about these growth estimates. So we said we're going to try and work out this intermediate growth rate and this long-term growth rate. The long-term growth rate, of course, is once again making, even if we accurately predict that, it's making an assumption that the company is going to keep on growing perpetually at this constant rate. So one way of projecting these intermediate future growth rates, the one for the next 5, 6, 7 years, we can do it by either going back ourselves and looking at what the company historically has grown by, and then we can try and extrapolate forwards to work out what we think is our best estimate, or we could just use some other person's estimates. We could go and look at growth forecasts from analysts. So I'm just going to try and share another screen with you again. So we go back to we go here, and I said, so this is Guru Focus. And I believe eToro has a deal with Guru Focus so that if you're an eToro customer, you will get free access to everything on their site. As I understand it, might not be right. So what I'm looking at here is for Coca-Cola, and we're looking at free cash flow per share growth estimate. So it tells us, so we got Coca-Cola's 3-year free cash flow growth rate range over the past 10 years. So we can see ourselves what the historical data is and try and extrapolate perhaps from that. Or as I say, we can look at what analysts have forecast themselves. And then when it comes to the long-term growth rate, this perpetual growth, we should be using something that's no higher than general economic growth so for the UK, it's about 2%. For the US, long-term, that's been around about 3%. And then we have this discount rate, the rate that we're going to take these future values of cash and then discount them back to present day values. There's different ways we can try and calculate this. One way is we can look at corporate bond yields as a kind of guide, and then we would want to add a bit on because our investment that we're looking at is going to be riskier than corporate bonds. Or we could use this thing that's called CAPM, the capital asset pricing model. So it's a model that attempts to tell you what the appropriate rate is for a given investment. So we'll start by looking at bond yields. which is a kind of rougher and readier method of doing it, but it's a bit easier. So if we wanted to attempt to estimate a discount rate for, let's say, Apple, so we're going to use Apple as our example, the computer giant or the iPhone maker, we could look at corporate bonds with 5 to 10 year maturities, because they're going to be across a similar kind of period that we're interested in for that intermediate growth rate of our company that we're trying to analyze. So I've taken these values from FINRA, FINRA, which is the financial industry regulator in America, and their website shows these values, and we can see that some of these corporate bonds for Apple, that the rates around about 4% when I took these. These aren't bang up to date, but they're not too old, and we can see, you know, some of them are 3.8 and 3.9, 4%, round about there. But we can't just use the bond yields as the discount rate, because the discount rate, as I said before, it should represent the risk an investor is taking putting money into the stock. So a stock is more risky than a bond in general. And this is because if you invest in a company, if the company gets into trouble and gets liquidated, if you own ordinary stock, you're actually at the back of the queue, unfortunately. There's all sorts of people ahead of you. The people who've actually lent the company are at the front of the queue. And then there's what we call preferred stockholders. And holders of preferred stock get paid out before ordinary stock. And common stock or ordinary stockholders, they get paid out last. So investing in stocks is quite a risky proposition in comparison to things, certainly to government bonds, but also to corporate bonds. So what we might do is add 1% or between a range of 1 to 5% to the yield, depending on the type of company, depending on how risky you rate that company. Apple, it's a big company. It's got a lot of cash, pretty stable. We might say 2.5% for the purposes of this example. But as with all these sort of things, it comes down to the judgment of the individual trader, the individual investor. You might think Apple's more risky than that, and then you'd want a higher rate, or maybe you'd value it slightly less and you'd use a smaller rate. But for the purposes of our example, we're going to add 2.5% onto that roughly 4% that we saw for those bond yields, and it gives us a discount rate of 6.5%. So that's the value we're going to use if we were using this method. But we've also got CAPM, slightly more involved method than that rough and ready bond method. So more complex, and there's different ways you can do this. This is to give you an idea of a fairly simple way of doing a CAPM calculation, but it's quite a broad subject. So we're trying to price in the specific risk investor is taking to invest their money in this stock. So the formula in general, this expected return, RE, equals the risk-free rate of return. So once again, that's a kind of notional thing, but what we could use is a very trustworthy government bond, for example, 10-year T-bill bonds, the US bonds, which might be, let's say, 3.5% currently. And then plus beta, which is a measure of a stock's volatility, or is how it moves relative to the broader market. So a stock with a beta greater than 1 moves more in general than the broader market, and a stock with a beta less than 1 will move less than the broader market in comparison to the broader market. So it's less volatile. And then beta multiplied by RM, an expected return of the stock market minus risk-free rate of return. So we can see that it's effectively the expected return, which is what we're going to use as our discount rate, the RE. It equals that risk-free rate of return plus a little something extra added on. And that little something extra added on is more according to how volatile the stock has historically been compared to the broader market. So some sample values. Risk-free rate of return, we say let's use 3.5%. We're saying we're just going to look at what a typical T-bond rate might be, 10-year T-bond. And then beta for Apple, we can look that up. Once again, Guru Focus will provide that. Lots of websites, financial websites, can tell you what the beta for a stock is. For Apple, the value I'm going to plug in here is 1.3. And then an expected market return, we can just use a long-term average for the stock market. So, for example, the 50-year annualized return for the S&P 500 index, one of the key benchmarks of the US stock market, it's round about 10%. So we're going to use that value. So now it's just a question of plugging in those values that we've got into our equation. So we're going to take our CAPM discount, which is our expected rate of return, equals the risk-free rate of return plus 0.1, the beta, 1.3 is the beta multiplied by the growth rate, 0.1 minus the risk-free rate of return. If we plug it all in, work through the numbers, it gives us this answer of 0.1195, and expressed as a percentage, that's 11.95%. So we can see that's given us a much higher value than when we looked at the bonds. We looked at the bonds and we saw that the yields were around about 4%. We added on about something like 2.5%, and we came up with 6.5%. But we're coming up with a much higher number using this CAPM based on the estimates that we've made for the different bits and pieces that we need to estimate. So let's say that the current free cash flow for Apple is $110 billion. So we've looked at the annual accounts for Apple. We go to the statement of cash flows. We look at the cash from operations, and then we subtract the capital expenditures, the CapEx, and we come up with this $110 billion as our free cash flow. And then we need to estimate a growth rate for Apple over the next 5 years, which is kind of what we're saying is that intermediate period. And the number I've got here as a sample value is we're estimating 20%. Once again, really important. What you got to understand is these are, to a degree, guesses. We're trying to make informed guesses, estimates, but there's nothing that says these are right. They could be way off the mark. We've got to bear that in mind. So the expected cash flow for 1 year ahead would be the current free cash flow, $110 billion, multiplied by 1.2. So that's 100% plus the 20%, 1.2, that growth rate of 20% for the next 5 years. And that gives us $132 billion. So we're saying that's our expected cash flow 1 year hence is $132 billion. So we've got the first one. We need to do that for each of the next few years up to 5 years for our intermediate period. So then for 2 years ahead, we take that 132, we multiply it by the 1.2 again, and we get $158.4 billion. We do that for each of the 5 years. And then when we've got each of those cash flows for the 5 years, we would need to discount back each of those future values to present value. And we use this equation here. Present value equals future value divided by bracket 1 plus R, and R is an interest rate, end bracket, to the power of N, where N is time. So let's work it through for year 2. We said that the expected year 2 cash flow, free cash flow, was $158.4 billion. Let's use our interest rate of 11.95%, the value that we got from our CAPM calculation. So the present value equals the 158.4 divided by bracket 1 plus the interest rate. We square it because it's 2 years for year 2. And then if we work those numbers through, it gives us a present day value of that future cash flow of $126.4 billion. So we've discounted our year 2 cash flow back to today. And we need to do that for everything else. That's just one part of our calculation. Now, it is easier to actually just do this using a spreadsheet. So we can just actually in a spreadsheet put present value equals bracket, put in the different values for all these different things, discount rate, number of periods, number of interim payments, future value. So for our one above, it's 1.1195, comma 2, comma 0, comma 158.4. And then the cell would just give you the present day value. Now we also have to pay attention to that terminal value, the residual value, which is like the big lump of cash that just represents the rest of the life of the company beyond the intermediate period. So we've said for our example, we're going to say the intermediate period is the first 5 years, and then we're assuming long-term growth after that. So then the terminal value would equal the cash flow we worked out for year 5 multiplied by 1 plus the long-term growth rate and then divide it all through by the discount rate minus the long-term growth rate. Using a discount rate of 11.95% and a growth rate, a long-term stock market growth rate or our economy growth rate of 3%, we might arrive at a terminal value of $3.15 trillion for Apple. So it's this big chunk of cash that we're just saying, okay, that's the rest of the life of Apple that is going to churn out. And then we need to discount that future value back to present value. So here's a table that shows the expected cash flows, free cash flows in the future, their values, and then discounted back to present values using the discounted rate that we were using of 11.95%. So we get all these values, we add them all up, and it tells us that our total estimate present value in this example is $2.47 trillion. And what can be sometimes easier to work with investors or traders find is just to work in actual share price values. So if we take the total number of shares outstanding, which is listed in the annual accounts, 15.9 billion shares, divide the 2.47 trillion by 15.9 billion, and it gives us our fair value, our intrinsic value of $156 per share. So that's the output, the end of our calculation that tells us what we think the intrinsic value of Apple is, $156 per share. And then we can look at what the current market value is of Apple. Now, the share price of Apple in late April, when I originally put this slide together, was $165 per share. Let me just go back to, so if I go to, we could, I'm just going to try and look up Apple in eToro's website. I've mistyped. We can see that the current share price for Apple is $178. So it's a bit more expensive now than it was when I put that slide together, but no problem. Either way, compared to my fair value calculation, Apple's looking a little bit expensive relative to its intrinsic value, either using the value I've got on the slide here, $165, or the value that it's currently trading at, $170 odd dollars. But this is just an example of the process, of course. And here's some good news in case I lost anyone going through those crazy calculations. Fortunately, we don't have to go through all those steps of working it all out for the various years and then discounting them back to present values. What exist out there, lots of websites that can do it all for you, which is one of the great comforts of our age, that we've got this the facilities to do these things very easily. So we can just plug the values in. We've still got to work out these estimates ourselves, but then the website will do the calculations for you. Once again, Guru Focus has a pretty easy to use DCF calculator on there, and this screenshot here just shows you an example of plugging in the values and coming out with a value. And that one's coming out in there. It's got a fair value of $140 a share, but it's using a margin of safety. So we talked about that margin of safety earlier. That one's given a margin of value safety of 23%. So it's pushing the fair value down even further. So potential issues. We said that there's all these estimates involved. Forecasting the growth rates, the cash flows, none of that is easy. It's not a doddle. It's not a trivial thing to do. Forecasting the discount rate is not easy. It's not trivial. You can make mistakes in doing it. You can be off the mark. And any valuation is only going to be as good as the numbers that you stick into it. So if you put in nonsense estimates, you're going to come out with a nonsense valuation at the end of it. So you've got to try and get those estimates, make them as well as you can. Mistakes that you make in those estimates can make a really big difference to the final value. So that's where the margin of safety comes in. That's why it's there. It provides a cushion against those mistakes that you might get from misestimating values. So you might add, I've got here, typical values might be anywhere from 20% to 40%, but it's down to the individual trader's discretion. It's down to you. And just a reminder here of the discounted cash flow formula again. Now, A similar concept is the dividend Gordon model. It's sort of another model for trying to work out the intrinsic value of a company using a kind of constant growth assumption. So, but this one is based on using expected dividends rather than fiddling around with free cash flow. So assumes the stock's value is directly related to the present value of its future dividends. So we've got this calculation where it's a summation, a series of summations of all the dividends across the lifetime of the company. It can be simplified to this: the present value equals the dividend for the next year divided through by an expected rate of return minus the expected dividend growth rate. So let's just look at an example of using this. So let's say we're trying to estimate an intrinsic value for Amex, American Express, the credit card company, big company in the S&P 500, worth billions. Next year's annual dividend, we have to make an estimate for it. So what we would do is we go back and look at what dividends it's given out in its history over the most recent years, looked at how it's grown those dividends, and we try and make some kind of estimate for next year. So I've made an estimate here for the purposes of our example that next year's annual dividend will be $2.60 per share. And then we make an expected rate of return, R, which I've estimated here to be 11%. So similar to that, we had the CAPM rate that we estimated or calculated in the previous one was about 11-12%. We've got here 11%, and then another estimate, a constant dividend growth rate, G, of 9.5%. So once again, we're making these assumptions and estimates that are subject to uncertainty. They could be wrong. So a constant dividend growth rate of 9.5%, you should be aware of how much of an assumption that is. Companies might freeze their dividends where they are. They might cut them. They might get rid of them entirely. What we're assuming is that it's going to keep on increasing the dividends by a constant rate forever. So then we plug those numbers into the equation. We get that our present value for the share price is $2.60 dividend per share divided by that expected rate of return minus the dividend growth rate. And we plug it all through and it says $173 per share. If we say that the most recent closing price of American Express is $150 per share, then using this methodology and using the estimates that I've plugged in, our dividend growth estimate here suggests it's undervalued hypothetically. Obviously, it's just an example. So we've looked at some different methods of trying to identify value in stocks. We've looked at using valuation ratios to compare peers with peer. We've looked at trying to look at what's on the balance sheet, tossing it all up, trying to get your own valuation there to work out whether the company's cheap or expensive. And we've just gone through a rather complicated example of a DCF analysis and also a dividend growth model. But once we've actually done all that, we've identified a company, well, this one looks cheap, either compared to its peers or according to your analysis. What do we do next? Let's talk about what we can do next. Well, what we can do is try and shoot holes in what you found out. So try and blow it up, try and pick the errors in your thinking, to go through the actual financial statements for the company and try to find an explanation for that low valuation. So it appears cheap. We're trying to work out, is it really cheap, or is there an actual explanation of why we're coming up with those numbers? Is there an enduring weakness in its business operation? Look at its sales, look at its cash flows, look at its net income. Is there anything there you can see that explains why the market is valuing it so lowly? Look at the balance sheet. Has it got too much debt? Is it unwieldy how much debt it's dealing with? Is that scaring people away? Or do you think, well, I can see why it's scaring people away. It's got a lot of debt, but I can handle that. You've got to make your own mind up. We talked about financial ratios. The debt to equity ratio is a way so you can compare it with others in the same industry to try and work out whether how it stacks up in terms of its debt to equity. Have a look in what the management's saying about the future. Are they saying they have any plans for acquisitions? Sometimes acquisitions don't work out so well. They can sometimes companies can choose to fund acquisitions by issuing new shares. When they issue new shares, it increases the number of shares that exist. That's diluting. It has a dilutive effect for shareholders, which means that your holding is, has a lower share equity value in the company because there's more shares out there than there were previously. Also, if your company is taking over a company where maybe its earnings aren't as strong as the company that's buying it, that can have a negative effect. And then very simple common sense check. It always pays to just try and apply some common sense. Does the business strategy seem sound to you? So tied in with that, you have to understand what the business does. It makes sense to you. If the business strategy doesn't seem sound, that's a red flag and you might want to just steer clear. And also try and spot things that aren't reflected in the company's valuation. For whatever reason, sometimes the market can get carried away with certain stocks that are flavor of the month, and other companies might just be overlooked, and you might be able to spot things on their balance sheet that have a value that the market isn't valuing for whatever reason. So it could be subsidiaries that are very valuable that aren't for whatever reason given the correct value, or intellectual property that's being undervalued, or maybe there's a stack of cash that for some reason the market's overlooking. And if you do decide to trade, you take a position in the company, don't forget to monitor your positions. Check RNS statements as they come out. These are new statements from the affecting the company directly that tell you what's going on. And if anything new happens, then you've got to constantly evaluate the situation, working out whether it means you cut back on what you've got or maybe add some more. And this idea of constantly monitoring your position, checking whether you should reduce your position, this is something we're going to discuss in more detail when we come to the final part of our presentation, which in quite a few weeks' time when we come to risk management. So we're going to end today's presentation just by a quick run through of some of the disadvantages of fundamental analysis. We've done 2 parts, 2 hours talking about fundamental analysis, looking at companies' financial statements, looking at how to compare a company with its peers, how to do a DCF analysis, intrinsic value, and all those sort of things. But here's some key things to bear in mind when you're doing a fundamental analysis. I did touch on this briefly last week. Timing. We might be correct in judging whether a company's overvalued or undervalued, but when we do fundamental analysis, it doesn't give us any information on the when. It doesn't tell us when things are going to happen. Where a company is trading on the stock market is the consensus of everyone who is participating in trading that stock. When you partake in value investing, you are being a contrarian. You're taking a view that you know more than everyone else, that they've got it wrong. So that can be, there's lots of clever people out there. Bear that in mind, that the market valuation isn't just by luck. People are looking, lots and lots of people, lots of money behind them. Intelligent investors are looking at, and what you might find where the market doesn't get it right is often, as I said before, it can be just that a stock is out of favor and these intelligent people aren't paying enough attention to it. But just bear that in mind, that the current valuation is the consensus of everyone else. And when you are value investing, you're saying your judgment is better than theirs. Fundamental analysis, it relies heavily on past data, old data. Doesn't mean that data is wrong, but it's not, you might be basing your decisions on data that is years old. There's an argument to be had about the relevance of that. And as we've seen, I've been at pains to point out that a lot of these valuation methods are relying on assumptions and on estimates, and those can be wrong. Finally, none of this stuff is easy and none of it is quick. It's time consuming. It does take a lot of time to actually properly look through the statement of accounts, to go through the income statement, the statement of cash flows, the balance sheet, and properly understand, especially when a company is very complicated, when it's got foreign cash flows coming in and there's hedging strategies going on. It takes a long time to go through all those different things. So a quick summary before we head into our Q&A session. So we said there are three main methods of valuing a company. There's the peer comparison. There's looking at the actual sort of value of its assets, taking away from its liabilities on the balance sheet. And then there is the trying to work out intrinsic value using discounted cash flow analysis. And we also looked in a similar vein at the dividend growth method. So discounted cash flow analysis is a key method, but as I've said, been at pains to stress, it's subject to key estimates that could be wrong. And make sure you do go through the actual financial accounts to confirm whether the value really is there or not. Okay, so that brings us on to the Q&A. I can see there's some questions in there. If you've got your questions standing by, put them in the Q&A right now, because I will be taking a look. Oh, I can see the numbers firing up. So let's see what we've got in there. Hi, missed last week's webinar. Will the recording be available to view offline? It should be. There should be an on-demand section on there. I don't have to hand the web address. However, what I'm going to do is I'm going to put Sam North's email address in the chat right now, and you can email him and he'll provide you a link to the on-demand stuff. So I've just put that into the chat now. And then I've got another question. Speaking of red flags, what does a negative equity tell us? How do you interpret that? That is a great question. I think it's going to be quite a long answer. What I'll do is, if you email Sam's email address it to me and ask that question, I'll fire you a written answer back. So another person asked, are these shared somewhere? Same question. They're on demand, as I understand it, and you can fire Sam an email. He'll provide you the link. Another question, are we going to delve into these valuation methods in the coming weeks? No. So I've gone through the valuation methods for fundamental analysis as best I can. And that's, as Matty was talking about last week, the idea of this course is to give us different looks, a 360-degree view of trading. So we're actually going to be expanding on from fundamental analysis to other areas. So next week, it's still sort of fundamentals. We're looking at a macro level, broadening our scope to the macro level. We're going to be moving away from shares to look at how that can affect all sorts of things. I mean, next week is the one I'm actually quite excited about, because it's things like FX and stock indices, commodities, and looking at news releases at a macro level, jobs reports, the non-farm payrolls, CPI, these kind of things, which I find very, very interesting. So that's what we're going to be doing next week. And then we're going to be spending quite a lot of time looking at technical analysis. One of the disadvantages we said at the end of fundamental analysis is the timing. This is going to give us some kind of an aid for the when, like giving us a time that it will, technical analysis tries to predict, okay, this change could be happening now. So we'll be spending quite a lot of time looking at that. Someone said, according to your example, do not buy Apple, therefore it is overpriced. Even Warren Buffett owns a lot of Apple. The example was not about trying to give a recommendation. So as I started the talk off with saying, none of the content in this presentation is about recommendations. It's all about education. It was a hypothetical example just to show you how you can do the analysis. And the numbers I used might be wrong. The assumptions I used might be wrong. So, obviously Warren Buffett is a very intelligent man, and I wouldn't necessarily go against anything Warren says. So there's a question here. In this equation, are we assuming that the expected rate of return potentially changes each year? I'd say potentially yes, because expected returns will change according to the risk appetite of the market and according to what the risk-free rate of return is. So we're currently in a a very different economic environment than we were just a few years ago. Currently, we're in a high inflation environment and interest rates have been on the rise. So we're seeing a cycle of interest rate rises from the central banks, from the Fed and from the MCP, the Bank of England, MPC, sorry, and the Bank of England in the UK and various other central banks have over the last few interest rate decisions tending to be tightening rates so that the risk-free rate of return is elevated compared to where it was, and that has a knock-on effect to what the expected rate of return is for putting your money in more risky investments like stocks. But if we go back, rewind the clock back to post-financial crisis, back to 2012, 2013, 2014, we saw an extended bull market, and it was a very low interest rate environment. Inflation tended to be fairly constrained because there were certain knocks on consumer spending at in various periods. If we look at what happened with the credit crunch and with in recent years with COVID, then it casts during those periods a very different outlook on trying to sort of search for yield, so that the expected rate of return for stocks would be lower when the risk-free rate of return was lower. Someone asking a question about if the model for dividend is also valid for our rights, REIT, or if we need to use a different model. These are all methods that investors and traders have tried to use to answer the question, to try and work out what intrinsic value is. There are more complicated versions of these things that try to do it better. They don't necessarily do it better. The dividend growth model, there are methods where you try and do what we did with a DCF, where you, rather than just say, okay, dividends are going to grow at this perpetual rate, you might try and break it up and try and be clever about it and say, okay, I expect they're going to grow faster over this intermediate period. They're going to slow off at bit point in the future. And you try and model your pricing based on that thinking. When it comes to things like an rights, where they're in, they're trusts that are based on usually owning property, real estate is intrinsic to what they are. You might find within the second of our three broad pigeonholes or buckets of valuation methods we talked about, trying to value property heavy things by looking at what's on the balance sheet, you might find, just because they're so fundamentally tied up with what property they own, that it's a more appropriate method to look at what's on the balance sheet and try and do your valuations of what they own against the way they're valued on the balance sheet. But once again, these things are always down to the discretion of the trader themselves. Someone else asking about Tesla and a very high PE. Why do people still invest in it in a fundamental aspect? Don't really like to comment on the particulars like this, but there are other factors that are at play. So it may be, and I'm not necessarily saying that is the case, that people are focusing on things like the growth of the company. That means that PE becomes a less useful yardstick in that instance, potentially. Someone asked, did you say that Guru Focus was free for eToro? Where can we find this to sign up? As I understand it, that is the case, but I might have been shooting from the hip. I'm independent of eToro. I'm not an eToro employee. I think the best one for that is fire an email off to Sam again, samno@etoro.com, and he'll be able to give you a definitive answer, or mark it for my attention and I can give you a definitive answer. He'll forward it on to me and I'll give you a definitive answer back. I'm going to get very repetitive with some of these answers. Someone's asking, a great presentation. Any chance you can email attendees the slides from this week and last? Please email Sam and he'll give you an answer back. Someone asking, is algorithmic trading, well, the question I think it's asking, can algorithmic trading save you time and do this analysis and provide you, I'm not quite sure what this means, but a 50% prediction? With algorithmic trading, algorithms by their very nature are designed to save us time. They're quick, they're convenient. I can't vouch for their accuracy or their successful or how successful they are. What I would say with trading is I prefaced the beginning of last week's talk by talking about how fundamental analysis and technical analysis are more art than science. If there was one absolutely 100% proven method that works for everyone, that was plugged into an algorithm, and it had been proven that it works, everyone would use it. So, unfortunately, what has to happen is that trader, when especially with fundamental analysis, your own personal judgment goes quite a long way into how good the analysis is. I think with algorithmic trading, it tends to be more on the side of technical than, because you can give it actual trading rules according to if this price, technical is being driven by price action. You can give it kind of statements that say, if these price conditions are met, then give me an alert or execute a trade. And algorithmic trading can be used for that purposes, but it's a bit like the DCF where we're saying it's only as good as the numbers you plug in. You plug in junk, you're going to get junk out the other side. And it's sort of the same thing applies with algorithmic trading. For that reason, I can't really, I have to give a kind of neutral answer and say, obviously it exists. I can't really say whether I think it's good or bad. Okay, someone's just saying they didn't get the email to write. I'll put it in the chat again. So here it goes. So I'm just putting in now Sam's email address again. If you've got any questions in terms about whether you can get the slides or whether you can get the on-demand link to the on-demand, then I would go to that. Or maybe you're not seeing it, but anyway, I'll say it. It's samno@etoro.com. Someone asking what's the difference between cash flow and free cash flow? Well, cash flow, we're saying if you're looking at the statement of cash flows, then you can see where the statement of cash flows begins is with the profit, the net income, which is really the bottom line from the income statement. And then there are adjustments that are made to sort of, because the net income takes off notional things that aren't really to do with cash, like things like depreciation, amortization. It adds some of those back in, but it ends up with a cash flow from operating activities. What we're saying with free cash flow is we're saying to run the business, there's a certain amount of money that is committed for expenditure on keeping the existing equipment. There's a certain amount of wear and tear that happens to equipment and to factories. So you've got to spend some money just to stand still, but companies will also reinvest in order to try and grow the company. You might, if a company is growing, then it's going to need bigger warehouses. It's going to need more machinery potentially. So that's capital expenditures. We're taking those capital expenditures away from the cash from operating activities to give us what we are considering the free cash flow, which is really a way of looking at it is the cash flow that is for the investors, for the shareholders, whereas there's some of that cash flow from operating activities is earmarked for going back into the business. That's the way I would describe it in a simple sense. Another question is, who is Sam and what is his email? Sam is Sam North. He's the sort of the presenter who does our beginner course. And actually what I would like to do is if there are any beginners here who just want more of an introduction than to trading than I provide, I'm putting in through a link here now that links through to the academy and the presentation for beginning investors. So that could be useful for if you're new to this. The cash. Someone asking about comparing cash operations, cash from investments as a safe check. I mean, what you can do with cash operations is it really wants to try and get your free cash flow, and there's lots of things you can do with it. Or potentially the list is endless. What you can do with any metric that you find from the company's statements, you can look at it and compare it to something else and divine some nuggets of information about implications for the business. What we often like to know from cash is whether the company's got enough cash to pay out what it is dealing with, to pay out what it owes, usually for the next year is a good one. So I went through the current ratio last time, where we're looking at it's you're sort of looking at its current funds available divided through by its but what it needs to pay out over the next year effectively. And that gives you, if the higher that number, the better position the company is to deal with its short-term liabilities. So does eToro offer Guru Focus subscription? As I said, as I understand it, that is the case, but you probably want to email I'm getting a bit repetitive. Email Sam and he'll be able to give you a definitive answer. Someone else asking, how can you determine the lifetime of a company? Well, obviously, like a lot of trading, you're dealing with an unknown. And that's why these concepts are kind of theoretical. You're not really trying to make a prediction for a specific lifetime of the company. You're trying to say, okay, effectively, you're saying the life of the company just keeps going on and on and on. But beyond a certain point, you can ignore its cash flow if it's sufficiently far in the future, because it discounts back to the present value. It becomes less significant. Is effectively what you're doing. So rather than trying to get into the impossible, getting yourself in the impossible situation of trying to work out what it's going to be doing in 75 years time or 55 years time, you're just going to say, okay, beyond the intermediate, we don't really know. We're trying to come up with this rough lump of cash that will be the residual value, the terminal value, which is its life after the intermediate. Someone asked, is this course recorded and we'll be able to watch it later in the eToro Academy? As I understand it, yes. And I'll just reiterate that answer one more time. Email Sam, and his email address is Sam, SAMNO, at eToro.com, and he should be able to provide you with any of the links that you need. Someone asked about, so they've said all that analyzing stuff is time consuming, as you said, and I agree. So is there, if there is quite a number of companies I'm interested in and I haven't got the time to analyze them all, is there a quicker way to filter out the most interesting ones that should be analyzed in depth? Well, this is something we covered last week. You may have missed it, but what we talked about last week is using, doing stock screens. So stock screens are things where you can put in the metrics that you're interested in and reduce the number of, you get back an answer that is a short list of companies that you can then focus on. So you could, for example, say I'm only interested in companies with a P under 20 as a starting point, and I'm only interested in companies with a market cap over $100 million, and I'm only interested in companies that pay a dividend yield of more than 1%. And using that method, you can quite quickly whittle down the number of stocks that are that you're considering, get a short list that then becomes more convenient to put more time into actually analyzing in depth. And Unfortunately, that is it for our time. We've run out of time. Thank you so much for attending. I enjoyed it. I hope I'm really amazed people stuck with me because it was pretty in depth. The good news is that we've got some really interesting stuff coming up in the future weeks. As I say, next week, broadening our scope to look at the macro. I'm really looking forward to it. So please join us again next week, and we're going to look at macroeconomic indicators. Thank you. Bye-bye.